Hello, welcome to today's Advisor Q&A. Thanks for joining us. I'm joined again, as usual, by my regular guests, Bruce Bramall.
Hi, Tony.
Hi, Bruce, and Max Noonan.
Hi, Tony.
Hi, Max. How are you?
Good.
Bruce, we're talking today about insurance. You've just moved home. I was going to say, I hope you've got your insurance in place.
Absolutely, yeah. Taking care of office, home, cars, the works, yeah. All needs to be done, yep.
Excellent, but we're not talking about that type of insurance today.
No.
We're talking about superannuation and insurance, and there's some changes that you've written about recently which make for interesting reading, because although they're primarily aimed at people in managed super accounts, they will affect some people with self-managed super funds, because so many SMSFs have insurance in a secondary super fund, which you might want to explain.
Yeah, well, look, some of the super funds are now sort of making the decision that they particularly for younger people, they don't want to have the extra costs of insurance, and they're going to start stripping back some of those accounts and make it non-compulsory, or to get rid of those insurances on some of the smaller accounts. For self-managed super funds, the main issues that need to be considered, particularly for those people setting up self-managed super funds. I've seen another horror story of this in recent weeks, where the super fund being set up was set up on the proviso that the previous insurances that were held in an industry fund were left in place. In order to leave them in place, you do what's called a partial rollover rather than a full rollover, because a full rollover will take all of the money out of the account and leave nothing there to pay the insurances. So making sure that, particularly when you're setting up self-managed super funds, that you've considered your insurances, and potentially the best solution is probably to get the insurances in your self-managed super fund. But for some people who are older or have some health conditions, it might be worthwhile holding on to the old industry fund or retail fund-based insurances and leaving some money there to be able to pay those insurances for a period of time. But in this example I was talking about before, it was supposed to be partial rollovers. Unfortunately, full rollovers occurred, and all insurances that were supposed to be kept outside of super, outside of the self-managed super fund and in their industry and retail funds, got wiped out. That couple have some health issues that's going to make getting the new insurances a little bit difficult. Or that might come with exclusions or loadings. So it's something that needs to be taken into account. So much care needs to be taken when doing these sorts of rollovers, in particular setting up self-managed super funds, or indeed consolidating super or moving super from one provider to another.
Bruce, I have a question. What was the industry fund that the people were in before when they rolled out?
I actually don't know the answer to that, because it was done by another advisor. They were coming to me for advice after the fact.
If it wasn't Australian Super, because I may have a solution for these people, Australian Super was the biggest, industry fund around, and new members, when they join, as long as Australian Super will be getting SGC contributions, do not have health checks up to a maximum of 600,000.
Yeah, there are.
And then if you've got a pre-existing illness, you've got to wait for 2 years, be a member without being able to claim if a pre-existing illness hits you. So from a point of view of those clients, it seems to me that as long as the SGC super contributions, if they weren't with Australian Super, and it's going to end up being a lesser cost, because I've just been doing a review for a client who had another financial advisor, in inverted commas so-called, did a plan for her, and she ended up with 5 different lots of insurances, 3 outside, 2 inside, and the amazing thing was 2 lots of income protection insurance. And anyone who knows the insurance game, income protection insurance, you can only ever collect on one policy.
No, not necessarily.
No, I've had it from the company.
Depending on if you're trying to cover 75% of both.
I'm talking about
incomes,
they're exactly.
Then you won't be able
exactly
to claim on
to
both.
65.
Correct,
So
yeah.
like the standard thing is to have someone in an industry fund that pays you for the first 2 years, and then you have a policy outside for a 2-year waiting period. These are exactly the same policies. So, it was clearly a commission grab by that particular agent, that particular advisor. So, you've really got to strip down. And the other big thing with, when you're looking at insurance inside super, you've got to do a cost-benefit analysis of inside super, income protection's getting you a tax deduction of 15%.
Absolutely.
And if you've got income protection outside of it, and especially if you can arrange it with that, it's worked out well to get the insurance inside the industry fund with the 2-year period and they get the 2-year waiting period, that the after-tax costs of having that outside of super gives you a lot better benefit.
I think, though, there was a limited time, Tony, up until, at the latest 1st of July this year, when having income protection inside a super fund, there might have been some reasons for doing it. A lot of those have been stripped away as of July 1, and this comes down to the reduced concessional contributions that we now have. Previous years, 30, 35, and years prior to that, $50,000, $100,000. You now, of the $25,000 that you're putting in, a higher proportion of it, because the limit has been reduced, will be soaked up in insurance premiums. People need insurance. I'm not trying to say they don't need insurance. They should sit down with somebody properly to work out exactly how much they have. But if you had previously $5,000 or $6,000 or $7,000 worth of premiums sitting inside your super fund, and you're able to put in $35,000 a year, well, you do the percentages on $5,000 of $35,000 versus $5,000 of $25,000, and it's becoming harder and harder to justify having as many or as much insurance sitting inside a super fund because of the amount of your ability to put money in that it's soaking up. So income protection in particular, for 2 reasons. The first one has already been raised by Max, is that the tax deduction inside a super fund is 15% versus somewhere between 34.5% and 47% for an individual outside super on those various marginal tax rates. That's the first reason that it should be held generally outside of super for income protection. The second reason is that the quality of the policies outside of super for income protection are better. And that has to do with the change they made in 2013, I think it was, where the insurance companies' payment provisions had to line up with super industry SIS Act allowances in order for it to be paid out. So some benefits had to be reduced on many policies. So for the quality of the policy and the higher tax deduction, in my opinion, income protection should always be taken outside of super. There will be limited occasion, maybe 5% of clients will do the income protection inside, and that will be a pure affordability basis. Where they literally their cash flow doesn't allow for a $1,000 or $2,000 a year policy outside of super, but it literally would be limited to less than 10, probably less than 5% of clients.
I think it's like this client I was talking about. As it turns out, she was pre-diabetic, and for some reason that seemed to have got missed in the data collection or the fact find. And she used to be a smoker, was a non-smoker at the time of taking out the policy, and had taken it up again. And on making further, inquiries, under those circumstances, if someone has been a smoker, given it up, and then take it up again, and heaven forbid that I would say that if insurance companies can find a way out of paying out on a claim, they will, but that would give the insurance company that, hey, we've insured you on the basis of being a non-smoker, you've now taken up smoking, what you have ended up coming down with is as a result of your smoking, we're not covering you. So there's that side of things you have to be very careful of. The other part of it too is from a point of view of the only time really when it becomes worthwhile getting it inside super, as you said, is if it's too cost prohibitive. Like with this client, we've done the calculations to get life and TPD out of the superannuation environment, like with an industry fund. You're looking at $5,000 and $6,000 and $7,000 because of the health situation. Getting it inside with a fund that doesn't have the health tests and doesn't have the loadings, we're talking about 1 or 2. So it's a real specialist area and has to be, well and truly thought through. And I think the thing about the income protection, what it was, some super funds used to be able to have a policy inside it where income protection was paid out on own profession, and then they had to change it. It had to be any profession.
That was one of the changes. Yeah,
Yeah,
there are a
that was
number
it.
of them, but a lot of the super funds were offering other advantages, other benefits on the side that had to be stripped off because they didn't fit in with the SIS Act regulations. But certainly with TPD nowadays, if you're with total and permanent disability insurance, it has to be you only have any occupation sitting inside super. The people who had own occupation prior to 2013 were grandfathered, so they were fine. But any new ones taken out from July 1, 2013 had to be any occupation and to line up with the SIS Act in order to allow claim payments to be made in the super fund and super fund to be able to pay out to the member. There had been situations where the insurance company had paid to the super fund, but then it couldn't meet a condition of release in order to get it out. So this money ended up being trapped in super for until they hit another condition of release, turning 60 and retiring, or finishing work, or turning 65. So that was some of the reasons for making those changes in 2013. We've almost skipped ahead a little bit though. In dealing with income protection, I guess first. There are four main insurances. Life insurance, pretty straightforward. You're either alive or you're not. Total and permanent disability insurance, which is essentially accident insurance, car accident, ending up in a wheelchair is probably the best way of thinking of it. Trauma insurance, which is illness insurance, heart attack, cancer, stroke, recovery money being paid to help you get over that, and income protection. Those first three are lump sums, but only two of them can be done inside a super fund. So only life and TPD can be done inside a super fund. Income protection, which can cover up to 75% of your income, as we've discussed, can also be done inside a super fund, but my strong preference is not to have that one in there. So the main insurances that people might consider to have in their super funds are life and TPD insurance.
Yeah. Let's come back to that a bit later, but I just wanted to clarify with these changes that are afoot with insurance and particularly inside industry funds. My understanding is that if an account has been inactive for, I believe it's 13 months, that the insurance will be cancelled or effectively disappear because that account will be deemed as being an inactive account.
Yeah, and there's a big danger in doing that, but they're opening the door for that to happen. I have a client, for example, in Sydney who I got to. I first met when she was about 2 or 3 years outside of breast cancer. She'd recovered and she was in remission. They came to see advice. Now the husband, clean bill of health, that was fine. Organising his insurance is no problem. But for her, she had 3 industry funds from various employers over a number of years, and trying to get her insurance being only so close to having come out of breast cancer. My advice was, well, we couldn't get her insurance anywhere else. The insurances weren't going to be available to her. But she ended up having a reasonable amount of insurance sitting inside those 3 super funds. $200,000 here, $300,000 there, another $100,000, $200,000 elsewhere. So she actually had sort of $800,000 worth of cover, which wasn't might have been $650 or $700. It wasn't much short of what we wanted for her. So the advice to her was just hold on to these funds. Don't ever do that. Now, she wasn't going to be making contributions to those funds on a regular basis. She was one of them was an active fund where her employer was paying into it, but the other 2 were crucially important for her to keep. Now, if these changes come into effect, and I'm sort of hoping that there will be some elements of further discussion around whether they do, she would lose them, or she would have to go through enormous pain of problems in order to either get her employer to pay for 4 months a year into this one, for 4 months a year into this one, and for 4 months into the year into this one, and then go back to the start again. It's if they're able to cancel after that 13-month period of not receiving any income into the fund in the form of SG or other concessional contributions, then yeah, there's a major problem.
Is the proposed change coming through from above? Because I can remember there was some talk and there was a bit of controversy about where the fact that the tax office, if a fund is regarded as inactive, they effectively get their grubby little hands on it, and then it doesn't necessarily mean it's gone, but it goes out of that super fund, goes into consolidated revenue or wherever it goes, and then if someone comes and says, hey, that's my super, it gets paid out then. Is that the interplay?
No, that's lost super. That's been around for years. So if a super fund can't get hold of you for a period of, I think generally 3 years, and there hasn't been any activity on the account, but mail's being returned, or there's no response coming from, the mail outs, then it goes into what's called lost super, and there's a bunch of providers, one of which is the tax office. When those super funds go to the ATO or one of the other providers' lost super accounts, they tend to be stripped of insurance just to protect the money that's in there. A much smaller fee is applied. Essentially, it's largely going to be sitting in cash, so earning 2% with maybe 0.5% worth of fees on it or so. Mostly those balances are fairly small, but sometimes they can be quite large, and people just have forgotten about them and forgot to tell their super provider that they've moved home or something like that, and it's a job from 5 or 10 years ago. There might have been $5, $10, $20,000 in there. But when they can't get hold of it, the reasoning is that they send it to these lost super providers who strip the insurance off and then just manage the money ultra conservatively to make sure that when these people do get back in touch, that their $25,000 hasn't become $15,000 or $10,000 or so. Often we're cleaning up balances of a couple $100 in these things, but it's better to get them and roll it in. But by the time it gets there, generally the insurance is completely cut off. So
I think the tax office has raised the threshold to about $6,000 now on those inactive accounts. So, which means they're scooping in much more revenue into lost super, but that's another story. With these proposed changes, though, for someone who's got an SMSF, where the bulk of their contributions are going, and they've got this industry fund on the side for insurance purposes, what do they need to do? Do they need to make sure that some of their contributions are going into the industry fund just to keep it ticking over?
Well, we're going to have to see what the providers do individually, and that might mean organising an annual rollover to the industry fund in order to keep the superannuation going, which is painful. There should be an allowance in there to make an election a positive election, as in you sent out paperwork, you've got insurance here, there hasn't been any contributions for a period of time, you're coming up to 13 months, we do notice you've got some insurance here, please sign, return, so that we can keep this open. But I'm not sure how much of this detail is going to make it.
What about the alternative of having the SGC at least going in? So, normally someone might have ended up putting 20 grand in there to pay for their insurance premiums for the next 10, 15 years or whatever it is. If it turns out that this is a threat, and we're talking about 9.5%, and depending on what that ends up being, is to end up rolling more of the money out of the industry fund or wherever the fund is that's got the insurance, have at least the SGC going to it. It's now an active fund, and then you don't have to worry about it.
Yeah, and then you've got to go through the same similar sort of process to roll over excess money. If you've got somebody earning $100,000 a year and $9,500 is going less than 15% tax, but then you're going to have a reasonable amount of money built up in these accounts. So if you've got a self-managed super fund and you've kept outside funds for insurance reasons almost solely, then you're just going to add to the paperwork of having to do a rollover every
I guess the thing though is
12 months.
If
you've got multiple accounts, how are you going to do that? If you've got an employer who's happy to send $3,000 here and $4,000 there,
but if you've got an active, if you're going to have to roll it in once a year to have a fund being active, by having the SGC going, as long as it doesn't create too much of a problem with the build-up, it might mean that you only have to roll out of that other fund once every 3 or 4 years. Gets it built up, and because doing it the other way, you've got to roll it in every year. Doing it, if the SGC is not creating a huge problem, you are at least having the activity. You've taken that off the table with effectively losing the super and the insurance, and then you can end up on a less regular basis doing the rollovers. It's just an option that I think needs to be considered.
It would be. It's creating hassle, paperwork. I just don't think it's been thought through properly.
That's unusual that someone would not think through legislation properly. I mean, go figure.
Who'd have thunk?
It's never happened before.
No.
Never. All right, look, I'll get to a few questions, and then perhaps we should also just broaden the discussion and talk about the this new event-based reporting, which you wrote about yesterday, I think it was, Bruce. Yep. There's been some changes there, so let's get on to that. But I'll go to a couple of questions first. All right. So, all right, well, the first question actually relates to what we've just been talking about, the moves to remove insurance cover on inactive super accounts. We've covered that one off. Okay, this is from Sally. I'm 55. My last annual super statement, I saw that the life and TPD insurance premiums basically eaten up most of my returns in 2016-17. I have 1.2 million cover, and my husband has the same in his super fund, so we're collectively paying $15,000 per year. Question is, at our age, is it better to cut down our cover?
Look, you need to sit down with somebody to work out whether you need cover. At age 55, do you need $1.2 million worth of cover? The answer might be yes, it might be no. It depends on what you've got outside, what your assets are, what your debts are. Are your kids off your hands yet? Hopefully, most people by age 55 won't need $1.2 million worth of cover, but there's not enough information. Sally hasn't provided enough information to know as to whether she should or not. If she's concerned about it eating into her super, then the other potential options are to take the cover outside of super, where you're paying for it in after-tax dollars and not getting the tax deduction for it. But it can make sense to do that and to have your covers, your life and TPD cover sitting outside of super. But at $15,000 at age 55, which will mean it's a stepped premium, so it increases with age. What you're going to be looking at is it's only going to get worse from here. It literally is an exponential rise in the cost of the premiums from here. But looking as to whether you need that $1.2 million, whether you can take it outside of super, or whether you should actually be starting to reduce it. When I talk to clients about the need for insurance, it starts at sort of age 30 and goes through a bell curve from 30 to about 60 or 65. In your younger years, you're getting married, you're having, buying a home, getting a mortgage, having a couple of children, maybe buying investment property, upgrading your home. Each of those ones, your reliance on your partner for financial assistance is increasing, and your needs for insurance are probably going to increase through that period. That peak comes when perhaps the kids are in their teens or so. You've done the heavy lifting for 13, 14, 15 years. And in 5, 6, 7 years they'll be off your hands or be able to sort of stand on their own. So you come down the other side by the kids turning 18, turning 21, home nearly paid off, some of your investments paying off, your super looking pretty good, and then at age 60 or 65 getting access to your super. So I would say with Sally here that she has probably gone over the curve and got to that point where potentially you're starting to cut the levels of cover and therefore the cost of the insurances. But without knowing a lot of those other factors, how old her children are, how much debt she's got, or the two of them have, is a little hard to say. But I would like to think, Max, that by age 55, your needs for insurance cover should be starting to reduce as your asset base is increasing and your liabilities hopefully are decreasing.
I've got an accountant's answer to that question, right? I'd take it a bit more from a figures-based thing. The first thing when it comes to life insurance, and you've already said this, is you total up all of your liabilities, your loans, and at the very least, unless you don't like your partner and you'd like to leave them with the debt, the idea is that you should at least have life cover that will pay out all of the loans, which means that is one financial burden on whoever is left is got rid of. After that, depending on your age and the younger you are, and you could possibly need more life insurances, which is talking about the bell curve, is that you need to take into consideration of, if I died in the next 12 months, how many years does my partner have left from a normal living point of view, and what is their income they require, and what is if they're not working and can't work, what is the capital value I need to be able to supply that so that they've got it. So that's the second part. So clearly, the older you get, the less you really need in life insurance, especially the more you've got in financial investment assets and superannuation, because if you look at how much capital is going to be needed to pay someone out so that they can live comfortably for the rest of their lives, you first work out how much capital would that be. Then you take off that the value of the current investments, whether it be net value of an investment property, their superannuation, and then you're coming down to, okay, this is the extra I need to add on top of the insurance I'm having to cover my liabilities that I need for life insurance. It's just saying that's more an accountant's answer than your answer.
So the broader answer is do plenty of research on what your needs are.
Speak to someone who understands this and can do a comprehensive analysis of what is it you really need. Are you overinsured? There are still people out there. I mean, insurance policies is one of the few areas that still have commissions in it. And because of the way the industry works, I'm not against that industry continuing that way, because the nature of insurance, and you'll have had this, because of the way the industry is, I can't charge the way I would normally charge a professional fee based on the time it takes to do the job and the professional expertise. Because I could do a lot of work for someone to try and get them insurance, and for whatever reason, maybe they didn't tell us something, or there's something that that happens and they can't get insurance. And therefore, to give them a fee for $2,000 or $3,000, $4,000, because that's the time that's gone into it, they can't afford it anyway. So the big thing is, unfortunately, there are still advisors out there because insurance commissions are still in place. Where, as I gave you the example before, I think whoever provided this advice to this new client of mine clearly was concentrating on the amount of commissions they could earn and not really looking after the. In fact, I've had a chat with a new client to say that we're going to go through the dispute resolution system to be trying to get, because I think there's a prima facie case for putting the best interest of the clients first has not been covered. So, but you've got to go through this exercise of working out how much insurance do I need.
Absolutely, very important. I've got a question from Simon. He's asking or saying, I'm wondering, are insurance premiums deducted from my total superannuation account balance when working out the pension account balance cap? As in, is the pension cap based on the account balance after my costs?
No. Two different things.
Yep.
One, accumulation. The superannuation relates to an accumulation account. Your accumulation account balance is counted in your total superannuation balance, which relates to the event-based reporting. Your pension account only has an effect on your transfer balance account, and you would never have, I've never heard of it, and I don't think you can, have an insurance policy within a pension account.
Oh, look, you could, but there's not a lot of, from a tax perspective, there's not a lot of point. If you're going to have insurance, particularly life and TBD insurance, then you want that in your superannuation or your accumulation balance to get at least some of that tax benefit from the deductibility of the premiums. So having it in your pension account generally isn't going to make sense. You'd almost be better off paying yourself out more of a pension and having this insurance policy sitting outside super, I would think. Yeah.
I'm just going to skip a question which we'll come back to. This next question is from Nigel, and he just really wants to know about the advantages of having your insurance inside super versus outside super, as in outside my SMSF versus inside the SMSF.
I think Bruce covered off on that. It comes down to if you can afford to have it outside of super because of the impost and the reducing factor it'll have on your accumulation account, have it outside super. If you can't afford the insurance but obviously need it, and the only place you can afford to have it is in your superannuation, well, That's pretty much it, isn't it?
That's essentially what I said, yeah. Look, a strong preference, the preference would be for everybody to have all of their insurances outside super. Life, TPD, trauma, income protection. From a costs perspective, that's not going to be feasible for everybody. So having your life and your TPD insurance inside super can often make sense. The older you get though, and the cost of that cover increasing, means that certainly for people probably from about their late 40s, early 50s onwards, the costs are going to start to really increase unless you're sensible enough to take out a level premium when you took out the insurance. But the costs are going to eat up more and more of your contributions. Hopefully, the cuts to contribution limits, we've seen the end of that at $25,000, and hopefully they're not going to fall any further. But for a lot of younger people in particular, in the 20s, 30s, 40s, getting those insurance, they're trying to save for a home, they're trying to pay school fees and save up so somebody can take a year off to be with the kids. Having your life and your TPD inside super then can make a lot more sense. But the older you get, the more likely it is that you should probably have that cover outside of super. The cost of the premiums, obviously, when you're young, are quite low, and can be essentially covered by putting extra contributions into super, either via salary sacrifice or under the new rules, where you're going to be able to put money in and get a tax deduction yourself for those contributions. So, from a tax perspective, there are some differences. If you have your life, the life, TPD, and trauma insurances, if you have those outside of super, you don't get a tax deduction for the premium. So there's no tax deduction for the cost of the insurance. But neither do you pay any tax if you get that. So if you have $1 million worth of life cover, TPD is probably a better example. If you have $1 million worth of TPD cover outside of super and something happens to you and you claim that $1 million, there is no tax to pay on that $1 million. You've never claimed the premium as a tax deduction, that you therefore don't pay it. And that applies to life, TPD, and trauma outside of super. Inside of super, however, you can't do trauma as discussed earlier, but you can do life and TPD insurance inside super, and you do get a tax deduction for them. Now, life insurance, if your super is being left, including the death premium, death cover that's been paid, if that death cover inside your super is being paid to a dependent, then there'll be no tax paid. So if I'm leaving my insurance cover, my life insurance, if I die, my life insurance cover goes into my super fund. If I'm leaving that to a dependent, my wife or my children, then that goes to them tax-free. If, however, it becomes part of your estate and there are no dependents, then there is going to be some tax to be paid on that insurance that has gone into your super. TPD, however, it's a horribly complex formula. I don't know if you sat down and played with it a bit, Max, but if you have a claim on TPD and that $1 million gets paid into your super fund for TPD, there is an element of tax to be paid on the way out of super. It's a complex formula involving how many days you're going to have in the workforce, how many days you've got left until you turn 65 or until your retirement date, and a couple of other factors in there. It's a complex formula, but there can be some tax to be paid. Inside super, because you've claimed that tax deduction, there may be some tax to pay on the way out, but it's a smaller amount and generally
with the
not too bad.
With the TPD, if someone's become total and permanently disabled, they have the ability to get out as a lump sum, which is you're talking about this complicated tax calculation method. If they're totally and permanently disabled, they have the other alternative, keeping it as a lump sum in super and getting a pension out of that. And even if they're under 60, they're at least getting the 15% offset. But another way of looking at this decision as to whether the insurance should be outside of super or inside super, another way of looking at it is, if a person has insurance outside of super at the present, and because of that coverage, all they're getting and all they can afford to have contributed to their super is SGC contributions. Let's say because all of their other commitments, that's all they can do. For every $600, let's call it $640, think again, $660 of insurance premiums that someone is paying for life insurance and TPD outside of super, because it's not tax deductible, they have to earn $1,000, right? They can actually improve their superannuation if, with the $1,000 that they were in pre-tax salary paying the insurance, if they go into a super fund where the 660 is the same, maybe slightly less, and are salary sacrificing $1,000 in that case, they've still got the same cover, but they've got $850 from the $1,000 they've put in. The 660 comes off, so they actually are building their super. So it really comes down to, from a superannuation and insurance point of view, if you can't afford to make salary sacrifice and extra super contributions, it's possibly worth looking at. If you can afford to maximise your super contributions, probably not. Would that be right?
Yep.
Yeah, yeah.
Just a question I have on TPD in your insurance, and you get a payout. You don't have to satisfy a condition of release to get that out?
You have met it.
You've met it.
Because one of the total and permanent disability is a condition of release.
Okay, thanks for that. Now, just the next question is really a segue into event-based reporting from Randall. He just wants to know what these new rules will be. I have more than $1 million in my account, so what will I need to report to the ATA? He understands that the new rules come into effect from July 1 next year.
Yeah, it's basically, if an event happens within a super fund's account that affects the transfer balance account, in other words, a pension is started or a pension is commuted, and they're really the only things that affect it, unless there's a personal injury case and they're not happening every day. But if either of those two events happen and you have a superannuation balance of more than $1 million, now this is the thing, it's not the amount of superannuation you have in your SMSF. It's the total superannuation balance that's taken into account. So you may only have $500,000 in your self-managed super fund, in a pension account, and I think the whole of life pensions are counted in your total superannuation balance. It's a part of, it definitely counts for transfer balance account, but if you're getting a pension that has had a value that's counted in your total superannuation balance, that puts you over the $1 million limit, where you might only have 500,000 there, but the other balance is counted towards your total superannuation, you're going to have to do the event-based reporting. And you've got to do it 28 days, within 28 days of the end of a quarter where an event happens, starting or ceasing a pension.
So what Max and I have variously written columns about and done presentations with Eureka readers about is, with the $1.6 million, what is often going to make sense is you take the minimum pension, 4%, 5%, 6%, depending on what your age is. Anything that you need in excess of that, it'll often be smarter to take a commutation of your pension. So you've got a $1.6 million pension, you've got to take 4%, that's $64,000. That's the minimum pension requirement you've got to do. Now, you could take a pension of $100,000, $150,000, but it makes sense that anything that you need in excess of your minimum pension requirement, that you take as a commutation of the pension. For a round number, just say $100,000 in this case. So their income requirements are $164,000. $64,000 is taken as a pension. The other $100,000 that they need can be taken as a commutation, which reduces their transfer balance account from 1.6 million down to 1.5 million. So at some stage in the future, potentially an inheritance, the sale of a property, whatever they need to do, they might be able to top up their pension account again with that $100,000. So what the events-based reporting is about is, if anything happens to your transfer balance account, it needs to be reported to the ATO within 28 days, the end of the quarter or a month?
Quarter.
The end of a quarter. So if you take out, in the July, you take out your $64,000, and in the December quarter, on whatever, November 17 or something, you take out of this extra 100,000 that you need, you take out $50,000 or so. At the end of that quarter, which will be December 31, within 28 days of the end of that period, you will need to make this notification to the ATO that you have taken $50,000 out as a that will reduce your transfer balance account from 1.6 in this case to 1.55. If you then take out the next $50,000 in the March quarter, and you do it on March 10 or whatever, March 31 comes around, you've got 28 days from the end of that to tell the ATO about this further $50,000 reduction in your transfer balance account that's taken it now from 1.55 to 1.5. So the concession that was announced in recent days was that it would sound like it was going to happen to everybody with a pension account balance who was going to had an event that was going to have an impact on their transfer balance account. But what the ATO has come out and said is that we're going to limit this to people with more than $1 million in total super balance. So if you've got $800,000 in your pension and you still have another $300,000 sitting in an accumulation account somewhere, you're going to need to do that. But if your total super balances are under $1 million, including pension and non-pension assets, super assets, then you won't need to be doing this reporting. The ATO has been particularly worried about people rigging or their come the end of the year and deciding, oh, hang on a second, I'm going to take that as a commutation rather than as a pension, having the impact of reducing their transfer balance account and maybe being able to top it up later. So this is what they're calling this, why they wanted to introduce this real-time reporting, or TBAR, so that these things can't be rigged after the event. The ATO has shown in the past that they don't necessarily trust self-managed super fund trustees enormously, which is why they tried to get rid of in-specie transfers about 3 years ago when they tried to get rid of that. That was purely, we don't trust that trustees are transferring these assets, in-specie transfer of the assets in a timely manner and at a price that's reasonable. And this is coming down to that. They just sort of the potential for some rigging of the transfer balance account balance, and that's where this was coming in. So at least there was a concession made. It'll only be for people or members with in excess of $1 million in pension and super. Yeah. So apparently that cuts out 85% of self-managed super funds.
Can I violently disagree with Bruce? It's not rigging. It's creative accounting. Now, come on. It's not. It's yes. I understand why they're doing it, because inevitably, and you've got to look at the real world. The real world, in most cases, people have a self-managed super fund. They've got a self-managed super fund because they like the control. Inevitably, if there's a pension account or accumulation, money's going in, money's going out, and the job of the accountant at the end of the 12-month period is to say, well, let's make some sense of this. This is what happened. How can we make this fit to make sure that if there's a pension account involved, they've met their minimum pension? Do we want to take the rest as extra pension? And it's become even more important that these sorts of things happen. What has happened now, though, is that people with self-managed super funds need to find a service provider that is not, and I use this analogy between the difference between tax agents and accountants, that is not a tax agent self-managed super fund specialist. Because tax agents prepare and lodge returns. That's what they do. Accounts, they're brilliant. An accountant does that stuff, but if they're a proper accountant, they're looking ahead, they're looking at strategies, they're looking at all sorts of things. They need to be looking ahead more, like you're talking about, is, okay, this is how much we need, 150,000, right? Our minimum pension is, that we've got to take, let's call it 100,000. We've only got if they've got a $1.6 million pension account, unless if they had an excess, has been rolled into another super fund, they've got an accumulation account. So therefore the thoughts need to go, okay, what makes more sense? Do we take it as a partial commutation sometime during the year, thinking ahead? Or do we take it as a lump sum payment out of the accumulation account? If it makes sense to take it out of the accumulation account, because the combination of the accumulation account and the pension account will have an effect on the pension transfer balance account, and the total superannuation account, is to work out where it's going to be. If it's going to make sense to have it as a partial commutation, work out when that's going to be happening and agree between the accountant and the client and say, this is what you're going to be taking out. We'll know it's happening here. Make sure you do. We'll phone you the day after or whatever it is to make sure it's happened, and then we'll lodge the form for you. Because the days of being able to have the accountant or the service provider clean up things afterwards are gone if you've got over that $1 million. There's going to be a lot more forward planning and thinking about and strategising, especially now we've got the 1.6 million in there, as to what is the best way to go. I had a phone call with a potential client today. He's unfortunately been diagnosed with a cancer. And I said, and he's looking at all sorts of things, and it's, we don't know how long he's got with things. And I've said that one of the things that I've always said to clients, if you've got a couple in a super fund, when one of them goes or one of them is got a life-threatening illness, that's the time to check and say, okay, let's look at, especially if they've got some high taxable superannuation account balances, what's the best thing going forward? Is it best to get it out now where we can get it out as a tax-free lump sum, or if we leave it in, it's going to go to our dependents and they're going to pay 17%? There's a lot more of this forward thinking and planning that needs to be done under this new regime.
Just explain for the listeners the practicalities of event-based reporting. So there's been an event which they do need to report after 28 days.
That's either a starting a pension, in other words, rolling from accumulation into a pension, or commuting, like Bruce and I have been talking about, where if someone needs more than the minimum pension account balance and it's been decided that it makes sense to take that as a commutation, which has the effect of decreasing your transfer balance account, they're the two events. So if either of those two events has happened, that's where you need to, within 28 days of the end of the quarter, if your total superannuation balances are more than $1 million.
So do we know yet what the mechanism for doing the reporting
There'll be a
is?
form.
There will be a form. It's unlikely to exist yet because the proclamation has only just been made. So we're still waiting on, what was the other form we were waiting on from earlier in the year?
Was that the capital gains tax?
Oh, yeah.
But that's been brilliantly solved. I don't know whether you know this.
No.
Now, all we have to do is to tick a box on the superannuation fund tax return that says, yes, we've claimed the CGT concession. That's it. As long as you have all of the documentation behind it to support what you've done, and the auditor will have had to have passed it, that's it. So it's very painless. So sometimes they can come up with what would someone even call common sense solutions.
No, surely not.
Yeah.
That would be amazing.
Yes.
Now, we're running a little bit early on questions. No more questions, but anything else you wanted to talk generally about what's happening in the super environment at the moment? We've had obviously all the big changes come through this year, which we've talked about ad infinitum. There's a few things coming through next year. Perhaps that can be another topic, such as the home downsizing. I think that's getting a lot of interest, so we won't do that today, but definitely maybe either for next time or early next year as it gets a little bit closer, we can talk about that.
We've got to see the whites of their eyes, the black and white legislation. When we've seen that, we're going to know what we can be doing. One of the things that we're going to be faced with the uncertainty of is we've got a federal election in, is it 18 months, 12 months? I don't know. It's going to sometime in the future. And unfortunately, with some of the interesting, and I'm using that in inverted commas, underlined, bolded, possible policies that are already been put forward by the other side of the political fence, I'm just hoping, unfortunately, as both political persuasions have, gone back to the old well of the superannuation to see what they can do to help balance the budget, that we're not going to have any more changes. I don't know whether you've seen any. I know there's got the changes that the Labor are saying that they're going to be starting to tax trusts, distributions at least at a 30%, so that if someone gets a trust distribution, they they can't use their tax-free level of income and the 19% tax rate to be able to, reduce their tax. So that's one thing that Labor's come up with. The other one is, and I hadn't realised this till recently, is currently when you get tax advice, tax planning advice, it's tax deductible and there's no limit on it. And in the interest of making everybody equal, despite the fact there are some people more equal than others, they are saying, we think that is bad, that the rich people can end up spending $50,000 on saving $1 in tax, and we don't like that idea. They're going to institute a maximum deduction for expenses relating to tax at $3,000 a year. So it'll be interesting to see, it's a watch this space as to where some of these policies are going. Hopefully they'll leave super alone, but I think with all of the changes that have happened now, the importance of looking at and planning ahead for the future is just become so much more important, especially like with one of the changes, which is a beneficial change, is this being able to carry forward the concessional contribution cap when you haven't used it up. Right? That's right. Yeah. Now, where I'm coming at, and I think we've mentioned this at a previous session we've had on this, is that if as a part of your retirement planning, you're going to have a capital gains tax event. In other words, if you have an investment property or a bunch of investments, that it makes sense to get it from that area where if you keep it in your hands, you're going to be paying tax on it once you've retired, to get it into super, and there's capital gains involved. It's all about timing as to when you do it. And it can make sense to be making, maximising your deductions, but there can be a time where it might make sense not to be eating up the 25,000 if you're planning in 5 years' time to be making a large capital gain, rather than all of that capital gain coming on top of the rest of your income, to be able to say, well, I won't do the salary sacrifice. If you're not over the 1.6, it might make sense to put it in as concessional after tax, maybe become eligible for the massive $500 if you're eligible. And so that what you're doing is you save up those unused concessional components that you can then use to decrease the tax to be payable on the capital gain. So there's a lot more of this thinking ahead and planning.
We can talk definitely more about that one as well next year, I would say, as it gets closer. But has that already come into effect for this financial year?
It's legislation, but it applies from concessional contributions from July 1, 2018.
Correct, yeah. So the 5-year catch-ups don't start until then. If you don't make any, or you have $10,000 worth of contributions for that'll be the FY 19, 20, 21, 22 years. If you put $10,000 in, you'll be able to do catch-ups 15, 15, 15, 15, plus the 25 that you could put in that 5th year. But contributions made or contributions not made in this current financial year won't count towards the 5-year catch-ups.
Is it that you can only carry forward 5, and is the last year inclusive? In other words, it's not the fact that you can have 5 years of 15 and then a 25. It's one of those interesting aspects of this.
You can only go back to 5 years. So in that, what are we talking? 18, 19, 20, 21, 22. So in 22, if you only put in $10,000 in 18,
all of those 5 years.
Well, you could put in 20. You might put in your 25 plus your 15. I'm guessing, and that would cover you off for that year. Actually, I'm not
it's
sure.
something we might
look into that.
Well, yeah, it's something it'd be a good one to come back to, because I'm not sure whether it's like in this case with the case of this shortfall, and assuming that's a $10,000 contribution each year. So for 4 years, I'm not sure whether we can end up having 60,000 plus the 25 go in, or whether in the 6th year you can have $75,000 plus the 25. That's
no. You certainly can't look back any more than
5 years.
Than 5 years. So in that 6th year, you can't go back to year 1.
Oh, okay.
So in the 6th year, if you didn't do all the catch-ups in year 5, in year 6 you won't be able to go back to year 1.
Then it goes back. So you're saying the 5th year is the final year. So you can only bring forward 4.
4 plus that year that you're in. So that's why they call it 5. But you, in that 5th year of the example that we've used, 10, 10, 10, 10, you've got 25 plus 4 lots of 15. You put in 60
So
plus
85,000.
85. And then that would cover you for 18, 19, 20, 21, 22.
Yep.
You'd have used up all of your contributions, $125,000 for that 5 years, and you'd effectively start FY23 with a fresh 25 and being able to do that again the following year. But what I'd be interested to find out is if you put in $40,000 in this 22, do you essentially allocate that 15 back to here? So in the following year, when that one drops off and 23 comes in, you've got 40,000 plus 10, 10, 10. Yeah, how that's going
Depends
to work.
on whether they use FIFO or LIFO.
Yes, correct. Yeah.
But going on from that, if you look at it, that we've got 4 lots of 15, which is 60, and we've got 25, going back to that planning forward to help reduce a capital gain, an $85,000 contribution, preferably, possibly, you would have planned to make the capital gain when you're 64 and you've retired and you're getting income in from your super fund that's tax-free, so you've got no other income. What that means is you can end up making a capital gain of $170,000, which comes down to $85,000 assessable, and that's the other thing that Labor's brought in. They're going to look at reducing the discount from 50 to 25. That's the other thing but assuming that we've still got the 50%, someone can make a $170,000 capital gain, $85,000 assessable, and by having been able to make that $85,000 deductible concessional contribution, they've ended up paying 15% on that 85 or 170, whereas if they hadn't been able to do that and their marginal rate was at, including Medicare levy, 34.5 or 39 or something like this, that's where it really comes into its own.
Well, potentially even higher than that because of tax-free thresholds.
Yeah.
But there is some good planning, which I wrote about very early on in the piece when the government when the changes were announced in the May 16 budget. That these sorts of opportunities were going to arise and from July 1 next year, we're going to be able to sort of start to, or in the lead up to that, be able to start to talk about people, particularly if you know you're going to be selling an asset in 2 or 3 years. If you're 62 or 63 and you've got a number of investment properties and you know you're going to need to sell one to provide capital to use as cash flow, and you're probably going to do that when you're 67, or before you're 65, if you're still going to meet work tests and whatever. There's some complications in there, but good planning opportunities. Being able to time the sale of that asset to a year when you could do that. Now, you won't be able to use, I don't think, the 5-year pull forwards after 65, potentially. I'm not sure, but certainly in that period in your 60s, if you're selling assets and being able to use the 5-year pull forward to reduce the capital gain tax that you might have to pay, as Max was saying. Some really good opportunities there for reducing tax and getting more money into super.
All right. Well, I think we've got plenty to talk about there for another time, actually. It sounds like there's plenty of meat in that topic.
Watch this space.
Watch this space. So we'll come back to that. Thanks again for joining us, gentlemen.
Pleasure.
As always. Thanks again for listening in. We hope we have covered off the ground you wanted to hear about, but we'll certainly come back with some more topics for next time and in the new year, and we'll see you then. Thanks for joining us.